Hello and welcome to the Adansonia Capital Global Opportunities Portfolio Update for March 2025. This is our disclaimer. Please read it at your leisure. To move forward, I'll take it as read. So, an update on the portfolio performance for March 2025. Despite the portfolio being defensively positioned and having around 18% cash, the portfolio still slightly underperformed a falling market for the month of March. This is largely due to the fact that growth stocks or US-based growth stocks got hit disproportionately hard versus the rest of the index. In saying that, the bright side of all this is that what we've seen recently in the last few days, that these are the shares which are just snapping back the hardest when the market is rallying. Interestingly, we're very comfortable with the portfolio and the valuation that we're currently seeing in it. Two stocks in particular, as an example. Alphabet or Google and TSMC are trading on around 14 times and have still excellent growth outlooks. We're very comfortable with these shares and possibly will adding to these judiciously at lower points than from here. And this sort of compares against Combank, which has just recently hit a fresh all-time high, which is trading at around 26, 27 times with no growth. The relativities here are just mind-boggling. So in saying that, the portfolio basically still remains still maintains around 17 to 80% cash. We traded nothing over the month of March and 12 stocks. This is performance of the portfolio graphically, cumulative returns since inception, and since inception we've been running at 15.7% per annum compounding versus the index as we defined it as 14.6%. So today, again, just talking about the Trump administration, we've done a lot of work of late, really just digging into the numbers. When President Trump announced the reciprocal tariffs on April 2nd, the shock to the market by the size of these tariffs straight away really caused a large knee-jerk reaction and qualitatively, spooked the market. And fears grew around the size of the tax or the tax impost on the U.S. consumer, the inflationary impact on the back of that, and obviously lifting the risk of stagflation. In saying that, when you actually look at the numbers, and what we try to do is we try to quantify some of these arguments or some of these impacts, and we sort of discuss them here. Including having a quick look at why the market has sold off as precipitously as it has, and effectively the impact of the Trump tariffs. So, look, to start off, just putting things in context, the US is 4% of the world's population, accounts for 25% of global GDP, but has 65% of the world's equity market. So it's punching above its weight in terms of the stock market. And also is strongly representative, not overrepresented in most global equity portfolios. On top of this, and obviously these numbers are all very fluid, as you can appreciate. Last reading we managed to find is that foreigners own around 33% of U.S. Treasury or U.S. government debt, and about 18% of the U.S. stock market. So what we saw is that obviously when the punitive tariffs came in, they're a lot higher than expected. It essentially raised the risk premium, the cost of capital for the market a lot faster than expected. It's unsettled the market, and essentially it largely precipitated a sell America strategy, where effectively you've seen capital outflows out of the US, which have impacted on stocks and bonds in the US dollar. All of them are lower. So lower bonds means higher yields. And what we've seen, there's been a dislocation between the bond market and the US dollar, which are traditionally safe havens or safe harbors, where when you've got a falling equity market or the market goes into risk off, you see essentially both bond prices and US dollars and the US dollar rise. And this is not happening at the moment. There's been any dislocation. So obviously, look, in saying that, trying to put some numbers around all of this, our expectation is that essentially the tariffs were as large as what they were to bring countries to the negotiating table with the Trump administration. But effectively, we believe that the base case for tariffs will largely be 10% across the board. This is where they'll end up, around 10% across the board, plus other sort of negotiated tariffs for special situations such as China and and countries where the trade deficit can't easily be closed. So when we look at a 10% tariff, let's just put that into some sort of context. I mean, it's akin to Australia's GST or the consumption tax, the VAT that you see in Europe, which is 19% in Germany and 20% in France and 22% in Italy. It's nothing new. And also what we're sort of seeing here is that while a lot of countries have been jumping up and down about the impost of these tariffs, I mean, what we're seeing hypocritically is that trading within the Western countries is not a level playing field. And we've done a paper which I'll speak to in a little bit, which just looks at the cost of some goods across the US after tariffs, versus in Europe, Australia, and China. And for case in point, it was a Porsche 911 Carrera, the base model, and it's still basically cheaper to buy a Porsche 911 in the US, in New York, even after state taxes in New York, than it is within Germany, and definitely within China and Australia, obviously being the most expensive with our luxury car tax. So there is a lot of hypocrisy here. Actually, if you look at it dispassionately. So why is Trump doing what he's doing? So Trump is obsessed with reducing the $1 trillion trade deficit he currently has. And if we look at our base case assumption of having a 10% on non-China imports, this would raise around US $350 billion in revenue per annum for the government. And the maths around this is basically in the brackets where the US currently is importing around $4 trillion of goods, less $440 billion from China, which is $3.5 trillion net of China. A 10% tariff on that is $350 billion. So again, looking into some of these numbers again, in 2024, the US enjoyed a 2%, well, didn't enjoy, the US, incurred a $2 trillion deficit on goods, with respect to its trade. In saying that, enjoyed a $1 trillion surplus on services to give a total trade deficit or net trade deficit of $1 trillion. China exported $440 billion to the US and imported $140 billion, which means that China is enjoying a surplus, or the US a trade deficit of $300 billion to China. So when you subtract that from the total trade deficit of $1 trillion, the trade deficit for the rest of the world, excluding China, is $700 billion. So that's $350 billion revenue injection from a 10% on non-China tariff on China imports. Basically works to halve that trade deficit with the rest of the world. And in saying that, just actually looking at the composition of the trade deficit in terms of being able to address it in greater detail, the trade deficit is concentrated really over 4 or 5 countries, including China, and it's basically concentrated over select industries, namely autos, which have already been discussed by the Trump tariffs, capital goods, and electronics. So again, you can largely see or start to quantify what Trump would do here with this tariff strategy. But more importantly, having a look at the way it impacts the US consumer, because this is the fear in the market. One of the major fears in the market, that it's essentially going to sink the US consumer. And when you actually start to look at it, we don't believe that this is really quite the case. So again, just looking at the numbers, the US GDP is around $30 trillion approximately, and consumption equates to about 70% of GDP. So that's around $21 trillion approximately. So as we spoke about in the previous slide, the US imports $4 trillion of goods, which is essentially less than 20% of the annual US consumption. And on top of that too, when you look at US consumption, that services account for 70% of US consumption, and goods are only 30%. So really, when you start to have a look at the size of the market that these tariffs are actually sort of impacting as a function of total GDP or consumption, it's not as pervasive as what is initially thought. So again, when you look at the headline tariff rates, and some of them are very punitive. EU around 20%, sort of matching largely the consumption taxes we spoke about before in different countries. Vietnam 46%, Thailand 36%, and Bangladesh 37%. And this is a starting point, I should say, for negotiations with these countries. It's not generally where they're going to end, but essentially, if you look at these tariffs prima facie, when you weight them across all the goods and services consumed in the U.S., including or recognizing that 80% of consumption within the U.S. is produced within the U.S., the actual impact on the U.S. consumer is nowhere near as bad as it sounds, and it's very unlikely in our view to be a cause of stagflation in terms of lifting inflation on these goods meaningfully as growth slows. Further, that also, if we look at the base case, the tariffs largely end up around 10%, excluding China, and that half is absorbed by the exporter, or exporters basically incur a little bit of margin pressure, and a stronger US dollar essentially also works to absorb some of the tariff impost. Then the implied inflationary impact on the US is less than 1%. Now, while we're not seeing a strong US dollar at the moment, we believe that Trump will basically support a strong US dollar policy, and this will essentially help this outcome. So, with an inflationary impact overall on our base case of around 1% or less, it's likely to be seen as transitory by the U.S. Federal Reserve. And importantly, if the Federal Reserve has to cut to combat slowing inflation, slowing growth, I should say, then inflation is not going to be impediment to reducing rates to basically help stimulate growth. Anyway, that's the end for the update for April. Please join me next month for May. And as always, contact details are on the front page here, bottom right. Please feel free to contact either Tony or myself directly or via our inquiries line on our website. Thank you very much.